favorite guest is back today on Kitco News, and you may not like what he has to say. It's Puru Saxena of Puru Saxena Wealth Management, and he joins me from Hong Kong. Puru, always a pleasure.
My pleasure.
All right, Puru, so it's been a long time since we last spoke, and I'm excited to get your point of view on the precious metals landscape right now. It seems to be that gold is in this state of limbo. What are your thoughts?
Well, Daniela, for the first time in many years, we don't have any exposure to gold or silver. We sold out of everything a while ago. And if you look at the price action recently, we're now in the seasonally strong time of the year. The spring period has been exceptionally good for gold and silver usually in the last 10 or 11 years. However, this time around, we haven't had any rally. Conversely, both gold and silver have now broken below the 200-day moving average, which has been support throughout this bull market. And I think investors had bid up the price of gold and silver in anticipation of QE3. But with the CPI in the US close to 3%, I suspect people would have to wait for the CPI to drop to around 1% before the Fed unleashes another round of QE3. And with the recent improvement in the economic data out of the US, I think money will leave precious metals and go into stocks, especially American stocks. And this is why we've seen a big rally on Wall Street. And gold and silver are facing some selling pressure.
Wow, so no positions in gold or silver. But Puru, what about the fact that growth is slowing down in Europe, in China? Would this not perhaps help gold, silver?
Well, you have to realize, Daniela, that precious metals have been rising for 11 years. So gold and silver are no longer cheap. They are no longer on the bargain table. And I know that the gold bugs and the silver bugs will say to you that the best investment strategy is to buy more gold and more silver at any price. But an obsession is not the best investment strategy. If you look at gold and silver today, gold has had a fabulous run over the last 11 years. It went up by about 750% last autumn. Silver has done even better. And in my view now, gold and silver are no longer the screaming bargains that they were 11 years ago. In fact, if you look at the gold-adjusted S&P 500 index, it has already dropped by about 90% over the last 12 years or so. And this decline in the S&P 500 gold-adjusted is very similar in magnitude to the declines we saw in the previous bear markets in US equities and in the previous bull market in gold. So I would be cautious here. I wouldn't bet the farm on gold and silver here. Unquestionably, if they do more QE, then gold and silver will go up. But I'm just not sure whether American stocks may not even go up more, because don't forget, US equities have done absolutely nothing for 12 years. We've had a massive trading range. And now the P ratios on American stocks are fairly compressed. Interest rates are low, and the Fed is hell-bent on pushing Wall Street higher. So I wouldn't put a large bet on gold, but I would still own some just in case as an insurance policy.
So are investors no longer viewing gold as a safe haven, Puru?
Well, if you look at the price action in 2008 and also last year, whenever you have a genuine credit strain and everybody scampers towards safe haven assets, it is interesting to note gold never goes up. And I know the gold bugs keep saying it's always going to go up and gold is the asset to own during times of distress. But if you look at what happens historically, gold gets sold off along with everything else. During times of a genuine distress, US treasuries go up, the US dollar goes up because there is a credit squeeze and there is a shortage of cash. Gold gets sold down, silver gets sold down. So I would argue that gold really is not a safe haven asset, it's just a liquidity play along with everything else.
So Puru, do you think the highs we saw in 2011 we might not see again?
Well, I don't know. I mean, I wish I knew. I'm not that smart. There is a probability that if they do QE3 or QE4 or QE5, then gold may go up even more in nominal terms. But when you look at the price of gold in relation to US equities, I would argue that American stocks are now reasonably cheap compared to gold. If you look at the Dow to gold ratio, it has gone down from about 44 to 1 to 7 or 8 to 1. As I said, the S&P gold adjusted has gone down already by about 90%. So US equities, in my view, today are where gold was about 10 or 11 years ago. Nobody likes US stocks now. Most people have written off America. And if you talk to people, especially on Kitco and other metal side, they despise US stocks. They think, well, America's finished and gold's going to come back into the monetary system. I disagree. I don't think gold's ever going to be allowed to come back into the monetary system. The banks are not going to put up with that. the Fed is not going to allow gold to be reinstated in the monetary system, because if they do that, then the Fed dollars, the US dollar bills, will go out of circulation, and you can bet your bottom dollar Bernanke is not going to want to have that.
Well, Bernanke just spoke to university students last week, Puru, where he stated that a return to the gold standard would be a waste of resources, and there may not be enough global supply of gold to support such an idea. What are your thoughts on that?
Of course not. That is ludicrous. You can set up the price of gold as high as you want. If you have an ounce at $100,000 an ounce, then you have enough gold. It's just a question of price. What Bernanke doesn't want is an anchor for the monetary system, because that prevents bailouts, that prevents monetary insanity, that prevents the debasement of the currency. And this whole fiat money system, Daniela, is based on the premise of bailing out the rich, bailing out the banks and Wall Street at the expense of the taxpayers via the stealth tax called inflation. And if you have gold or seashells or salt or wooden sticks or anything else backing the paper money system, then the central banks won't be allowed to print more cash, and they wouldn't tolerate that.
All right, Puru, so what trading range are you looking at for gold in the next 6 months?
Well, we are now entering the seasonally difficult time of the year, Daniela. As you know, gold and silver have had a tendency to sell off in April and May, and they usually base out around August or September. My best guess is that we would go sideways. In fact, I think the best outcome over the next few months is a sideways drift or a sideways trading range. But investors and traders should also be prepared for a deeper pullback, especially if the US dollar index rallies from here. In my view, I wouldn't establish long positions in gold and silver until both gold and silver go back above the 200-day moving average. As long as they're below the 200-day moving average, I would consider a trend to be down.
Puru, I know you were big on palladium in the past. What's your feeling now on the PGMs?
Well, if you look at the economy now, Daniela, the economy is now very different than where it was 5 or 6 years ago, when precious metals were in demand. Platinum was in demand, palladium was in demand. Platinum and palladium really are a play on the auto demand all over the world. And with China slowing down, Europe in recession, and the US growing moderately, I'm not very bullish on the industrial commodities. In fact, for the first time in many years, we have a very limited exposure to crude oil. And apart from that, we are out of pretty much all commodities, all miners, and we are focusing more on the growth stocks, which are growing their earnings at a rapid clip all over the world, because I think money is flowing into equities, and you can see that with price action.
Okay, Puru, you just mentioned gold stocks, and that's what our viewers mostly want to know is when will they perform well again? Do you see a rosy picture for them?
Well, I don't own any gold stocks at the moment. I've been watching the Philadelphia Gold and Silver Index, the Amex Gold Bugs Index, and what I see there on the weekly charts, Daniela, is a big rolling top. The chart pattern doesn't look very good to me at all, and I know a lot of people will come on Kitco and tell everybody that the gold to the gold stock ratio is very favorable for gold stocks and we could have a big rally. But the same people have been calling a rally for the last 5 years. It hasn't happened. My view is that in a gold bull market, you want to own the actual metal, or you want to own the junior mining companies, which offer significant upside potential because of exploration. I think the bulk of the gains in the big cap or the mid cap producers are now behind us. In fact, the chart looks pretty bearish for the gold mining stocks, and they've been making a series of lower highs and lower lows, and that to me is a downtrend. So I would be very cautious here.
All right, Puru, what price would gold have to get back down to in order for you to get back into the game?
I would buy gold only if the price of gold closes above the 200-day moving average. I'm not in the business of buying the dips. I prefer for the trend to get established first. We follow a trend following system in our money management programs. And I feel more comfortable, Daniela, buying something when a trend is already established. And usually for anything, whether it is gold or silver or oil or stocks, if anything breaks above the 200-day moving average, that is a pretty good sign that buying power has come back in the game. At the moment, sellers are dominating gold. And as long as buyers come back in, I would stay out and let the market reveal its hand. No point trying to pick the bottom. You don't know where the bottom is. And if you wait for a confirmation, wait for the price to go above the 200 moving average, in my view, you may have to pay a bit more, but then your downside would be very limited. At least you can put a stop loss 5 or 6% below the 200-day moving average, and you will know what your maximum loss is or your maximum risk is. Trying to buy the dip is a very risky proposition when it comes to precious metals.
All right, Puru, final thoughts, anything we should really be paying attention to that could influence the market?
Well, I would pay a close attention to the US dollar index because that determines what is happening in the precious metals market. And as I said, this is not the time to bet your farm on gold and silver, and I know I'm going to get a lot of hate mail for saying this, but if you look at history has shown that when any asset has had a huge run-up over 10 or 11 years, especially something like gold or silver, then it is time to be more cautious. In terms of precious metals, the risk is directly proportionate to the price level. It's not the opposite. Most people think gold has gone up by 700%, therefore it's going to go up by another 7,000%. All I know is that late in the bull market, you get many forecasts, and the cheerleaders get even more vocal, and that to me is the time to be more cautious, not more aggressive.
All right, Puru, thanks so much. Hope to see you on this side of the pond soon.
My pleasure, Daniela, anytime.
And thanks for watching Kitco News. You can email me. I'm sure you'll have plenty to say after this interview at newsfeedback@kitco.com. For Kitco News, I'm Daniela Comboni.